Nigeria is likely to be included in the JP Morgan's government bond index for emerging markets. That's from October, potentially bringing up to $1 billion into one of Africa's most developed debt markets. Joining us now to take a look at this, Mark Khalil, Head of Institutional Sales at Standard Bank. Mark, great to have you with us as always. So before, of course, we get into the ramifications of this, which of course is very exciting, it seems, let's talk about the mechanics, exactly what bonds are likely to be included and what is the time period.
Thank you, Sam, and what a heads up for the African continent. They're recognizing African continents like Nigeria as an up-and-coming frontier market. Regarding the potential inclusion, they are looking at a series of 3 bonds, the 2014 2-year, 2019 7-year, 2022 10-year bonds. They haven't given exactly which bonds those should be, but it'll probably be the benchmark bonds, which are your most liquid. And they're looking to phase in the inclusion into the said index 1st of October, 1st of November, 1st of December over a 3-month period, just so that they can accommodate for investor demand, considering the liquidity in the market.
Now, of course, just according to estimates, $173 billion in assets under management are benchmarked against this index. So if you've got Nigeria with a weighting of 0.59%, what does that mean likely for the amount of money that will come into the bond market?
The estimates being candid around right now is that $1 billion could be earmarked for Nigerian federal government bonds. The number you mentioned was those investors and participants benchmarking against the JP Morgan Emerging Market Index. And it's very important to see when that appetite will flow into the market. Usually it could be on rebalancing date, October, November, December, but as soon as news hits the wires, you do see the demand. So already yesterday we had our monthly bond auction where $473 million was auctioned into the market in terms of 3, 5 and 10-year bonds. It was heavily oversubscribed. The yields were between 15.90 and 16.30. And if you look back a couple of months ago, yields were above 18 and 20%. There's reignited investor interest into Nigeria. This will only help further the cause.
I mean, we've seen with South Africa potentially being included in the Citi World Government Bond Index, what it's meant for our bond market. We've seen 67.3 billion rand flowing in, net flows in terms of foreign investment into local bonds. Is this going to put Nigerian bonds on the same trajectory? Are we going to continue to see a rally and appetite for Nigerian bonds?
Thank you. South Africa being recognized more as a developed market economy. If you look at the bonds that trade, daily value is probably $3 to $4 billion. In Nigeria, the secondary market is second in volume traded only to South Africa, but that's around $400 million. So I think we need to recognize that it's being recognized in a frontier market index. It is slightly less liquid, and yet in terms of benchmark performance, you still can get the healthy appreciation of yield compression. Nigeria T-bills were 20% a month ago. They're currently 18%. So if the decision's taken not to participate in the index and stay naked, with yields coming down, the investors who track this benchmark index will lose out.
Yeah. What about the fact that it's 0.59%, you know, and it is a small weighting? Are there going to be some investors which choose not to go ahead with that and invest in bonds, even though they are tracking the overall index?
Correct. It is difficult to access Nigeria and particular African markets. Just setting up custody is difficult. Every time you buy an underlying asset, you need a certificate of capital importation to show that you've bought the asset. At Standard Bank, we offer easier vehicles of access. So credit-linked notes and derivatives where we can give you very, very easy access into the market. So participants can easily buy the Nigeria component. Those who tend not to buy it and stay away, it will be minuscule in terms of missing out. And yet, if you get this heavy yield compression, it's not going to be great on a benchmark portfolio. It's important to notice that you've got Nigeria, but you've got a lot of other smaller frontier market companies. and countries that only make up like 1%. So if you're not participating in all the countries, when you accumulate it, you may not be benchmarked correctly.
And of course, I mean, the head of this index and this JP Morgan government bond index pointing out the fact that you've got Nigerian yields sitting north of 16% and the average yield on the actual index sitting at 5.8%. So of course, there's huge opportunity there to take advantage of the premium. You'd wonder why investors wouldn't want to go into Nigeria.
Nigeria, North African markets, if you look at Ghana, that's currently offering you around 18% as well. But the currency stabilized, it's come back from the levels of 175 to the dollar to 156. It is managed band. They call it a hydrocarbon producer currency country, very reliant on oil. It's got a very good balance of payments. It's got current account surplus, high yield. So we're very and fundamentally poised for a retracement and rebound. We do like Nigeria, we like Ghana, and you've already seen in East Africa with Kenya and Uganda compressing yields after the recent sell-off. It is one of our topics, and with the healthy demand expected, we would advocate the buy.
What does this mean for government in terms of issuing of new bonds? I mean, if you do see a strong inflow into the market from foreigners, you see yields coming down, does this just create more scope to continue to be able to, issue debt for local programs?
That's an excellent question. The DMO, the Debt Management Office, who issue bonds on behalf of the Ministry of Finance in Nigeria, have already said that with the maturing bonds, the rolling maturities due for the next couple of years, they'd like to push it longer dated into your 7, 10, 15, even 20-year bonds. So they are happy to issue longer dated. Investors like the longer duration. You should see a healthier pipeline of issuance just to meet the demand. So all in all, liquidity should be a bit better. It's very important to look at the local investor, the local pension funds. A lot of the money that they hold, they keep locally, so they hold to term investors. There's currently $15 billion worth of dollars of pension fund assets, and they expect that to grow by 35% a year, assets being managed. So in terms of opportunity going forward, and in terms of bond issuance, it's very positive.
I mean, Mark, what is your sense right now as to foreign interest and foreign attitude towards putting money, perhaps hard cash, or perhaps investing in the capital market into Nigeria from investors you speak to? Are you just seeing heightened interest, or there's still some concerns?
No, I think on the equity market, if you look across asset class, obviously Nigeria and the equity markets have been down. Those have retraced. There's more focus on the liquidity now of actually accessing these financial markets. We link in with our investment banking team all the time. On the origination side, they're talking to corporates, talking to issuers. Everybody wants to come to market just to be able to meet this pent-up demand that we do expect. So the markets are maturing on the capital market side, on the originating side, and on the financial market side, on the investor side. So we're just setting up our framework so that we can cater for both, to meet both sets of demand.